Hello guys, welcome to the channel. In today's video, we're going to talk about how to create a diversified portfolio and why it is very important for your long-term stock market success. Don't forget to smash that like and subscribe button, and let's get into the video. A diversified portfolio is an investment portfolio that contains a mix of different sectors. The goal of diversification is to spread investments across a variety of assets and reduce the overall risk of the portfolio. A diversified portfolio typically includes investments with different characteristics such as varying levels of risk, return potential, and correlation to each other. The idea is that if one investment performs poorly, other investments in the portfolio might perform better, offsetting potential losses and stabilizing overall returns. With the basic understanding of diversification, let's analyze why it is very critical for long-term success. To start with, it should be stated that the majority of stock market investors are not emotionally stable and they aren't objective. Due to this, if your portfolio is not diversified enough and you're heavily invested in a specific sector, your portfolio could embrace a lot of pain very rapidly if that sector is affected negatively in the short term. And due to lack of objectivity, investors tend to sell their assets when the market is crashing, and this will be a Ragnarok situation for you. Diversification saves you from this situation. Of course, you can still lose money in the stock market even with a well-diverse portfolio, but due to investing in several sectors and different types of companies, even if some sectors perform badly, you will be compensated by other sectors that are performing well. The greatest examples of diversified portfolios could be some index funds, such as the SPY. And the SPY is an index fund that you can buy through the allowance of your brokerage, and it invests equally into the top 500 largest companies in the New York Stock Exchange. Besides ETFs, investors usually prefer to create their own diversified portfolios. To achieve this, there are different strategies used by different investors. For example, Peter Lynch prefers to invest over 100 companies at the same time, creating a very diverse portfolio. On the other hand, Warren Buffett also believes the idea of diversification, but he believes investing around between 10 to 30 companies, because he argues that finding 100 plus companies that are well established to invest is very difficult and risky due to the difficulty of managing the portfolio. Instead finding 15 to 20 very well established, high growth, low debt, and high free cash flow businesses from different sectors with good entry prices will lead to long-term success in the stock market, according to his opinion. Moreover, diversification also allows you to capture opportunities that you would have missed normally. To evaluate if your portfolio consisted only 2-3 stocks, this could be very risky because your whole investing future is dependent on the performance of 2-3 companies. And even if you think these companies are great and will be perfect investments in the future, you need to weigh in the possibility that you can be wrong, as many great investors have been in their careers. With diversification, you will be invested in more innovative companies. This way, you will have the possibility to land a big outperformer stock in the long term compared to a smaller portfolio. Also, if you're wrong, with a not diversified portfolio, the losses could be far more significant in a bear market. Last but not least, let us create a diversified portfolio to demonstrate diversification. To start with, the selected stock should be from different sectors. The S&P 500 has 11 different sectors. Some of these sectors are communication services, consumer discretionary, consumer staples, energy, and financials. It should be stated that you're not required to invest in every sector to create a diversified portfolio. You can just invest in several sectors that you choose. For our case, let's hypothetically say we have $100,000 and we wanted to create a diverse portfolio. Okay then, let's start building our portfolio. We said hypothetically we had $100,000. I would set 10 to 15% of that money to cash, because there could be a bear market, stock market can crash, and at that time we need to buy. That's why let's put 10 to 15% of our money to cash, and we're left with $85,000. Now, hypothetically, let's say we want to invest in 5 different sectors, and we want to put our money equally to those 5 different sectors. Then we divide 85,000 with 5, and that gives us 17,000. Then we understood that we want to put $17,000 to each sector. Now we're in the last step. We selected our sector. We know how much we're going to put into the sectors. We know how much we're going to keep in cash. Lastly, we need to select the stocks from each sector. Hypothetically, and according to my suggestion, but you should do your own due diligence and your own research. To create a diversified portfolio, I would recommend 15 to 20 stocks, and we selected 5 sectors at total. That's why aim to select 2 to 3 stocks per sector, and that will give us a total number of 15 stocks, and that will create a diversified portfolio consisting of 15 stocks and 5 sectors. And how are you going to select these stocks? You could look into different metrics. I would recommend high growth, high cash flow growth, high free cash flow companies, high revenue growth companies. That is preferably low PE, because we have great companies that have a lot of unexplainable prices. You shouldn't pay a lot of money for a great company, because you could still pay an unreasonable price for a great company. For example, Tesla would be a good example. Tesla was around $1,200 before the stock split. It's a great company, but it was overpriced and it crashed. That's why you should select your stocks according to looking at different metrics that you could use, as I stated, and you can add a lot of more metrics according to your own knowledge and on your research. After we selected our companies and after we selected our sectors, we know what to do. We given $17,000 to each sector. We put that money to each sector into a couple of stocks, and there we go. You have your diversified portfolio. You have 15 stocks. You have invested in 5 different sectors. You have $15,000 in cash if a rainy day comes, and if stock markets crash, you have the purchasing power and the willingness to buy. And yeah, that's how you create a diversified portfolio. There could be different ways to do it. This is just an example that I wanted to portray to you. You can play with the numbers. You could do 25% cash. Some people would do 10%, maybe even 5% cash, but I would find that too risky. But you could change the numbers, or if you want to invest more heavily on specific sectors such as technology or consumer discretionary services, this is your choice. But a perfect diversified portfolio I wanted to create and perfectly equally. That's why I chose these numbers. If you liked the video, don't forget to smash the like and subscribe button and join the family. We're continuing with the daily upload, and if you have any different video ideas, let me know in the comment section down below. Take care.